Good day, y'all. Thanks for joining me on today. I'm excited to have this discussion. Today is Friday, April 12th. We are still in Financial Literacy Month, and we are going to talk about some credit card terms today. Yes, I'm excited about that because I think we must continue to educate ourselves on the options that we have available. My name is Deb Howard. Let me introduce myself. I'm an abundant life coach. I help faith based leaders and entrepreneurs overcome limiting beliefs about money so they can live their most abundant life. I love doing it. I love getting into the details of things uncommon for me because I don't do it too much on lives. We're going to get into some details today. We are going to talk about credit card terms. Now, I know some of you have credit cards. Maybe some of you don't have credit cards. You may have different feelings about credit cards, but that's what we're talking about today. I do think it's important as we consider Financial Literacy Month that we understand the language of money. Credit cards are part of our currency system. Um, I will just say from the get go that credit cards are really for the disciplined. You probably don't like to hear that. You probably, some of you may listen to this and think, what? Credit cards are really for the disciplined because it requires discipline. But even with discipline, it requires knowledge, right? Because you need to understand exactly what you're getting into, right? We want to make informed decisions. That's what financial literacy is really about understanding, right? Financial terms, financial going ons, right? Systems, so that we can make an informed decision. So it's not going to be long because sometimes a few things can overwhelm us. So I don't want to overwhelm us, right? But I do want us to be educated, right? And so we are. We're going to talk about some financial terms. Yes, I'm back to my presentation, but I'm gonna put it like that. How about that, right? So you can still save it. So yeah. So this month, let me make sure I have my mic right. We're talking about financial literacy, and so the first term, right, we're going to talk about is APR. Very common term, APR. You hear that all of the time, I'm sure. If you purchased anything on credit, whether it's a car, a credit card, if you have a credit card, whatever, you've heard of the APR or the annual percentage rate. The annual percentage rate or APR just represents the cost of the money that you're borrowing, right? And I think even when we talk about financial literacy, it's important for us to understand that we are borrowing money, okay? Whether it is on a credit card, if you charge something on a credit card, you are borrowing money, right? And sometimes we think, I don't know, I think sometimes we make that separation in our mind, right? That, I'm making a payment. You're paying back a loan that you requested. Okay. And so that annual percentage rate represents the amount that the bank says, you know what? I'll loan you the money, but I'm going to charge you this percentage of the balance every month. APR, annual percentage rate, right? So they give you a rate for the year, like 5% in our example here. We're talking about a car loan. You wish you could get a new car for $20,000. Listen, but this is for an example. I had to keep my math simple. So if you purchase a car for $20,000 and you're blessed enough to get an interest rate at 5%, don't listen to them commercials. Listen, and you get an interest rate for 5%. Interest over 1 year is around $1,000, right? But the interest is compound, excluding the effects of compounding. We're not going to talk about compounding in this example, but for this, if you buy a car for 20,000, the first year, your interest will be about $1,000. Now, that's a simple example. So you're saying, okay, 21,000 is not bad to purchase a car. So this is the thing with cars. They will compute the interest over the entire, term of the loan. right? So if you buy a $20,000 car, I know this is funny to you, but you might find one, maybe a used one. Let's say that. Anyway, over the term, right? So we always, finance over several years. So let's say, I know we go up to 6 or 7 years now, but let's keep it around 5 years, just for example. Over the term of that loan, and these are not real numbers, you'll probably pay around 15,000 in interest, right? I mean, if you compute it out year by year, the math, all that kind of stuff, you're usually paying close to double. When we're financing things over a longer period of time, we're paying a good amount in interest. All right. And there are calculators online. You can figure that out because it depends on the interest rate and the term of your loan. But for our example, so this $20,000 car that I'm financing for 5 years is already costing me $35,000. Right. I'm already past that little 20,000 cheap note I thought I was going to have. Now, it'll be a cheap note because they're going to break it up over 5 years. But what the bank does is they determine, okay, we're going to get $15,000 in interest over the term of this loan, but we're going to include that early in the payments, right? We're going to put the majority of that interest money in the beginning of the loan. So if you really look at, for instance, a car loan, let's say your note was $500, you're probably paying 350 in interest. And you're like, wait a minute, I thought my interest rate was 5%. It is, right, over the term of that loan if you have a fixed rate. We're gonna get into that too. But if not, then yeah, they're putting the majority of that money. Let me turn that phone off. At the beginning of your loan, which is why sometimes, and I've been there, y'all. I done everything, so I've been there. If you for some reason have to turn that car back in, that's a nice way of putting it, right? Don't you love when people say that? My mom used to say, we're gonna just turn that car in if you get a repo. Let's say you've been paying on it 2 years and the car has to be repoed, and you're like, why is my balance still $19,500? That's why it's still $19,000 because the bank, and that's smart business, right? They're like, listen, we're gonna loan you the money, but we're gonna get our money first. Because listen, mm, right? So they tend to there's a calculator. I don't want to get too deep into it, but just know that, right? That when you finance, same with the house, right? When you purchase a home, you easily over the 30 years of that, or if it's 30 years, you're easily paying double for that home. Easily. Right. Especially now. It might even be more because the interest rates are higher. Right. But the banks, your financing companies are going to include a bigger portion of the interest dollars at the beginning of the loan, right? So the first few years of the loan, that's why you typically don't see your balance decreasing that quickly because you're paying interest, right? Sometimes I've heard people say, oh, it's because of, mortgage insurance, all of that too. But the majority of it is interest. And so we have to understand that the APR is important. We want a lower interest rate, but please make that connection that this is the cost to borrow the money. So even if it's credit cards, I said we're talking about credit cards today. So even credit cards, same thing, right? Each month you'll see the interest rate, or I'm sorry, the interest amount that they're charging you on your credit card. I said at the beginning that credit cards are for disciplined people because the idea is that you pay off that balance at the end of the month. If you don't want to pay interest, then you need to pay off your amount, your credit card balance at the end of every month. If you charge $50, typically you got around 25 days in a billing statement before your due date. You have that 25 days or so that you can borrow the money interest free. We'll put it that way. But once you get your statement, whatever balance is there, you need to pay it off in order to not pay interest. So credit cards can be used in a good way. They can be, but it requires discipline. And can I say, and I'm guilty too, many of us don't have that type of discipline. Listen, when I first got a credit card, I'm gonna share this and then we go boop. Yeah, and some of y'all know my story, so y'all know I had horrible credit. Or listen, it was decades for them people to give me a credit card again. Whole nother story. But when I did get a credit card, I would see stuff on sale because I was excited about, to me, having extra money. Look, I didn't have no extra money from my paycheck, but I had this credit card that had $1,000 on it. So I'm like, I got some money. So I see something on sale. It had to be a good sale because I'm a bargain shopper. So it had to be a good sale. And if it was a good sale, then I would put it on my credit card. Cause I thought, child, even with that little back then, 9% interest or whatever, I'm still getting a deal because this is 75% off. Of course, though, I wasn't educated enough to understand that, oh, they're going to charge me every month for this. They're going to keep adding interest every month that I don't pay it because I didn't have the money to pay it off. And so I'm continually getting charged. Y'all already know how that story ended. I don't even have to tell you, right? Because of course I kept charging. Of course because things would actually come up that weren't on sale, right? I need a tire. I need this, that, and the other. So I was using credit cards for extra money and for my emergency fund. Let me not get into that too much. So yes. So APR, that's our first thing. I hope we understand that. And if you have questions, feel free to put them in the comments. All right, so let's go to our next term. Compound interest. So we just talked about it a little bit. Compound interest can work for us though, but it can work against us too. It's the interest calculated, on that initial principal, but it also includes all the accumulated interest from previous periods. So if we go back to our credit card, right? So maybe I have $1,000 limit. Maybe I put $100 on there. Right? I don't pay it off. I'm gonna pay the minimum, right? Minimum is $10. So I'm gonna still have that $90 balance next month, right? They're gonna add interest, right? Whatever that is, let's say $10. And so I'll make my $10 payment again. But what's about to happen? I'm gonna still have a $90 balance. Why? Because the interest rate is still being charged. The interest rate is being charged on the balance, and that includes any additional interest that's added on. So if they charge another, I paid $10 that first month because, it's no interest that first month. So anyway, next month is $90. They're going to add on, right, whatever the interest is, right, for that month that they calculated. And we'll say $10. So now my balance is back at $100. But I'm going to still pay my minimum $10 because I ain't got the money. I can only afford to pay the balance. So I pay my $10 again, it's 90. They still looking at it, but now my interest rate, I'm carrying this balance, right? And so they're calculating on that balance. The next month they add another $10. Right now I'm at $100. I'm paying interest. I'm making my minimum payment, but I'm not seeing, right, my interest go down. I'm not seeing my balance go down. I'm not seeing it go down because if the bank is charging me $10 in interest and I'm making the minimum payment, and it's usually a little more than the interest payment, so it might be $12, right? Only $2 is really going towards my balance, that $90 balance, right? So each month, right? It's a raggedy example, but y'all get the picture. Each month, I am continuing to accrue a balance because of interest. And if I'm only making the minimum payments, then I'm really not going to impact that balance. It's going to continue to go up over time if I don't make a bigger payment. And God forbid I'm still charging on the card, right? God forbid that I'm buying other stuff and adding to that balance. It gets more and more difficult to catch up. Now I know we're talking about $100 or whatever, $1,000, but most of us, when we charge on our credit cards, because credit card companies can be very generous, right? They might give you a 5,000. You might call them, and they might even increase your ceiling, right? Your maximum amount that you can charge. They might increase it, but you have to be the disciplined one, because if you are not able to pay off that balance at the end of the month, let me tell you, that's usually going to be a first sign that you're in trouble. Okay. So interest can work for us too. So in my example here, if we have compound interest, and many of you that maybe have a 401k or something, you probably are benefiting from compound interest. Same thing, if you invest money, they're compounding your interest usually over time if you're in the stock market, or if you have that kind of thing going on, right? So if you invest $4,000, same 5% annually, listen, the first year you'll have $4,200, right? Because 5% of 4,000 is $200. But that second year, as you can see, it's going up, right? Because now that 5% is based on the $4,200. So now I'm gonna have $4,400, right? A 4,410. And then the last year, the third year, I'm gonna have 4,630, 50. So you begin to see that's compounding, because that 5% interest that they're paying you is now being calculated on whatever balance is in that account, right? So including the interest that they're paying you each year. That's why compounding interest is powerful if you can leave the money over an extended period of time. Because the first year you might say, girl, oh, they 5%, $200. I mean, that ain't that much. Okay, the second year, okay, I got it $210 or whatever it is, right? That's not that much. But over time, right? This is why a lot of people advocate the stock market or some type of investment that you can leave over time. That's why the sooner you start investing, if you can leave that money, the more likely you'll be able to really reap the benefits of compounding interest. If you start investing at 20 and leave it in there until you're 70, right? Even if you don't continue to contribute. If you continue to contribute, that's even better. But if you could put, and I advocate this for us parents, if you can put $1,000, $2,000, $3,000 somewhere for your son or daughter, for your kid when they're born, and leave it there until whenever, until they're getting ready to go to college, they're going to have the benefits of that compounding interest, right? And they'll have they have a little change, right? So these are things that we can do, but we want to understand when we talk about compounding interest, if I'm investing, it's great. So I want to get the best rate that I can get. And I know it's kind of tough here. I think earlier in the week, I posted something in the Facebook group about savings accounts and about finding a high yielding savings account, right? High yielding mean that they pay an interest rate higher than the norm. Some banks aren't even paying much of an interest for savings accounts. Some of them are paying, 0.5%, 1%. Listen, this is your money. They're using your money. That's what they do. That's what banks do. They use your money, y'all. If you didn't know that. Well, right, because we're talking about loans. So we're making a loan basically. We put money in a savings account. We're saying, okay, this is our savings. Bank hold it. You think they just holding it? No, they're using your money. So you need to find some place that will pay you more than 0.5% or 1%. And there are several out there right now. I think the highest I've seen is 6%. But you still, if you can find a bank that's paying you 5%, yeah, because money needs movement. I don't want to get too deep into that because we're talking about terms today. But you need to keep your money moving, right? That means it's a current, right? So you want to keep it moving. It's currency. So find a savings account. If you don't have an emergency fund, I know I said I wasn't get into all that today, but you need an emergency fund. You need a rainy day fund. You need an unplanned expenses fund, right? And that needs to be preferably in a savings account, because preferably you're not going to be going into that money every month, right? And so earn interest on that money and get the effects of compounding interest. So compounding interest is interest on top of interest, right? I'm earning interest, and then the bank is continuing to pay me not on my initial balance, but on whatever my balance is, over whatever period of time they're paying the compounding interest, right? It could be monthly, it could be yearly, right? So I want to get the best rate when it comes to me. But when it comes to buying a home or a car, I want to be educated. When you look at what the interest rate is, you need to be educated. All right. Don't just think I got this $20,000 car. Okay, they're gonna charge me $1,000, because it's a 5% interest rate. No, 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 no. Right. They're going to compute that interest over the life of that loan. And you know what? And that's assuming that you're on time with your payments. That's assuming that you have a fixed rate. Let's go to fixed versus variable rates. That's assuming some things, right? So if there's any variable, right, in your structure, right, with that loan, then that could be impacted, right? Your rate can be impacted. Your the amount, rather, I should say, your final total cost of that loan can be impacted because there's fixed rates and there are variable rates, right? So we're talking about interest rates. Fixed rates, just what they sound like, don't change. So if I'm buying a house or a car, I want a fixed rate. I don't need any surprises. I know a lot of us hate surprises. So we need to be educated when we go purchase something. Is this a fixed rate or is this a variable rate? A fixed rate does not change. Whether it's mortgage or a car loan, right? Because that's usually the bigger things, right? It doesn't change over the term of that loan. So if they say it's 5%, it's 5% throughout the term of that loan. A variable rate, which is also called an adjustable rate or a floating rate. You probably heard adjustable rate from the mortgage scandal, not scandal, but dilemma we had here in America years ago. Adjustable rate mortgages or adjustable interest rates fluctuate, right? So they can fluctuate based on the market, they can fluctuate based on an index rate. If you have a credit card, you know that they can fluctuate because your credit card company says we're going up on interest rate, right? It can fluctuate, especially with credit cards, if you're late. Now let's talk about this just for a minute, because if you're late on a payment, they can usually, if they want to, and it's probably in your terms when you get this credit card, that little booklet they give you that outlines the terms of the credit card. Yeah, it's probably in there. But many times they can send you to a default rate if you miss payments on your credit card, which means they can start charging you the highest rate available, basically. Right. So in this instance, maybe they're charging you. I know we with that 5%, child, ain't no credit cards. Anyway, let's get a little normal. Let's say that your credit card rate is 15%, right? That's probably about middle of the ground or somewhere in there. Uh if you miss a couple of payments, they can say, you know what, we're gonna put you on a default rate. We're gonna take you up to 29%. Now that makes a big difference, right? 15 to 29. So you need to be aware of this. What does my credit card statement say? Am I going to be able to pay off this debt at the end of the month, or am I going to continue to carry a balance? Right? You can be honest with yourself. If I'm a carrier balance, then I need to be on time because I have this interest rate right now. But understand that if I miss payments, if I don't and miss payments, I'm not saying it was only a day, it was only 2 days. You know how the credit card companies are, and if you don't know, let me tell you, you better make that payment like before the due date, if not on the due date, because I was only a day late. Oh, it was 12:05. That only works a few times. Right? Yeah, you can call the credit card company, and sometimes, yeah, you can usually get them to take it off the first, second time. But listen, after a minute, they're gonna be like, thank you. We're gonna get that extra money from you. Right. So we're gonna increase that interest rate. We're gonna charge you a late fee. We have to understand the banking system, right? They're in it to make money too. So you borrowed the money. You agreed that your due date is on the 15th. If you pay on the 16th, yeah, we're going to add on $30. Yeah, we're going to go ahead and up that interest rate. Yeah, we might even add on another fee because we just want to, right? So we have to understand that variable rate, that's what that means, that they can raise the credit card. They can raise the interest rate. If you get a home loan, that's a whole nother thing. Sometimes it can be beneficial, sometimes not. But you have to understand that with a variable rate, they can go up or sometimes it can go down, right? But most of the time, it's probably going to go up, and it's going to affect your payment. It's going to affect whether it's your mortgage or the minimum amount due on your credit card, right? It's going to impact that. So understand that when I'm going into a loan, right, especially a big loan, is this going to be a fixed rate or a variable rate? Don't let them fast talk you, right? It's variable, but it's going to be good for you, and because the economy, be educated, right? So a variable rate can go up. All right, and then the last thing we're going to talk about, y'all, is just some common credit card fees, right? And so if you have a credit card, check and see if you have an annual fee. I found a lot of people don't even know. so credit cards, some credit cards can have an annual fee. I'm not advocating one or the other because I do believe it depends on your situation. Cards that have an annual fee many times give reward points, you know, their benefits, there might be cash back, etc. Listen, just understand it, right? Just understand that sometimes that an annual fee is the charge for yearly use of the card. So every year they say, you know what, we're gonna, charge you, I don't know, $95 a year for the benefits of using this card. Right. You might say, why am I paying them? Okay, like I said, sometimes they're reward points, sometimes they have cash back programs. Some of those type of cards that you hear about on television, a lot of times they have an annual fee. So you're going to have to, if you're trying to get the system, as they say, right? If you're trying to get over in some way, or, and I don't want to say get over, but benefit from it, you have to know, am I disciplined enough to deal with that? And number two, how often am I going to use this card, right? Is it going to benefit me to pay them $95 a year, right, to get these benefits? Right. So look and determine, does this card have an annual fee? Many cards have all cards, let me say it that way, have a balance transfer fee. And you may hear credit counselors out there telling you consolidate your debt, and they may look at, and I'm not saying it's bad, but they may say, if you got these higher credit card rates, right? Maybe you got cards at 18, 20, 29% interest, and you got this one card, that doesn't have a big balance, and maybe your interest rate is 10%, right? So is it beneficial to transfer all that debt there? That's what, maybe, I don't know. But understand that most of the time they have a balance transfer fee. So when you're transferring that card to this new card, right? The new card is saying, "Oh, you're gonna let us handle your balance, cool. 2, 5, whatever percentage of the money that you're transferring, we're gonna charge as a fee." Right? So you need to look into that. Is it going to be worth it for me to transfer this money over here for this lower interest rate? Because I'm also going to have to pay a balance transfer fee to them, right? I'm going to have to pay them to take the money so I can get the lower interest rate, right? Or to put it on that card, right? Because the banks have to make money, right? So be educated about that. That, yeah, you can transfer it. Now sometimes they'll give you, there might be a promo out there, free balance transfers or whatever. Look at the fine print. Make sure you understand what the parameters are for that, because the rules are the rules, and if you break the rules, that's going to lead you into some kind of default state, right? Higher interest rate, whatever it is, additional charge, whatever it is. So we have to be informed, right? All right, balance transfer fee, over the limit fees. I don't have to tell you about that. If you go over the limit, sometimes credit card company, maybe your limit is $1,000. You want to charge something for $1,200. Cool, we'll let you charge it. Yeah, we'll clear that. But now you have an over the limit fee. Over the limit fee might be $50, right? So when you get that credit card statement, not only do they want the minimum balance, right? They don't just want that. They want all that $200 plus that $50 that they've charged on for the over the limit fee. So be aware of your limits. Stay, if you have credit cards, right? Stay educated, stay informed. And then late fees, we kind of talked about that already. If you don't make that minimum payment, they're going to charge you a late fee. And they're going to want that late fee in your next payment. Right. So you usually see it included in your minimum payment. Minimum payment is $20, right? And you were late making that $20 payment, then you'll see I think usually it's around $30, right? You'll see that $30 in your next credit card statement, right? So instead of having a $20 minimum fee, you'll have 20 plus the $30 late charge. Because again, the bank is always trying to get what you owe them up front. And that's not a bad, yeah, I mean, I'm not mad at them about it because it's not a bad philosophy. But we have to understand what's happening. I've had people say, I don't understand why my minimum balance went up. And when we look at it, oh, it's because you were late last month. Oh, it's because the interest rate, your introductory interest rate, is no longer in effect. You see that kind of terminology, right? Introductory interest rate. How long is that interest rate for? Be careful with these promos because sometimes, right, they give you an introductory rate of, let's say, 5%. But if you have a balance, sometimes they'll go back and add all the interest that they would have gotten if the interest rate was 18%. Right? So be careful. If you do an introductory rate, then make sure that you can pay off your balance within the time or before that introductory rate ends. Same thing with promos, right? The promotional rates, right? 5 years, no interest. I think I told this story before, but I bought some furnitures many years ago on one of these. It wasn't 5 years, child. It was like 12 months, 12 months interest free. And I was like, cool. Right? I can make these payments. I don't have to worry about interest. And I was happy. The problem was that I didn't understand after the 12 months, the balance needed to be paid for that interest to not be charged to me. I didn't pay off the furniture in the 12 months. And lo and behold, I look at my statement and there's like another $500 on there. I'm like, whoa. I called them and they said, "Oh, you didn't pay off your balance within the promotional period." I didn't understand that. All right. So understand that promotional periods, right? Promotional interest rates and all of that. Understand what the time period is, right? Maybe it's not, if you can't pay it off within that period, maybe it's not even beneficial for you, right? To take that promotional rate. Because what they do in that instance for me is they go back to the beginning of the loan and they say, okay, you didn't pay off your balance within the 12-month promotional period. So all the interest that we would have been charging you, we're going to put it on your balance now. Yeah. So these are things that occur. So anyway, long story short, y'all, we got to be educated. We've got to understand these things. So I really wanted to, and we could talk. I mean, yeah, there's a whole lot of other stuff, but we just don't have time because I already been on here. Lord, 30 something minutes. So listen, thanks for joining me. I want to say to us that the point of financial literacy is just understanding and being informed. And one of the things that we have to get past is being afraid to look at our finances. It's being afraid to ask questions. It's being afraid to deal with the things that we just have to deal with. We can make decisions and maybe they're, regardless, right? Maybe you think, oh, I shouldn't even be using credit cards. That's beside the point if you have one. Right? So I need to be informed about how the bank is talking to me or writing to me or emailing me, what these things mean, right? I need to have enough information so I can determine, is this right for me? Oh, they're offering this promotional rate, right? I don't want to just jump on it. It sounds good, but I want to be informed. Am I going to be able to pay this off in that period? What are the consequences if I don't pay it off? Do I even need to indulge in that? Because I don't want a surprise at the end. Do I have the discipline to deal with this? Okay. So that's our live for today. Thank you guys for joining me. Listen, I do hope that thank you. I do hope this has been beneficial to you because I want us to be informed. Listen, knowledge is power. And we can make whatever decision we want to make. We just need to be informed about it. All right. Let's not be ignorant about the very thing that we are living on. Are we living on money or not? Yes, we are. We living on money. Don't fool yourself. So we need to be informed about it. We need to be informed about it. All right, y'all. So don't forget, I'll be back live. I forgot when, next week. But also don't forget about our summit. Listen, October 19th, 2024. I'm excited. And you know what? We might be talking about some of these things more in depth. Because listen, we could talk hours about this. We could talk hours about credit cards. We could. Because child, they're trying to make money. And we just need to understand how they're doing it, right? So that we can avoid the pitfalls. So listen, thanks for joining me. Thank you. Thank you. I'm glad that it's been beneficial. Thanks, love, for being here. All of you for being here. And listen, you know what I'm going to say? Go have your most abundant day. I'll see you next week.